when markets are rising, everyone's an expert. And we've seen that in the last 5 years through this wave of buyers agents, and a lot of investors have done well, but a fair bit of it's been just like when the tide rises, all ships rise. However, the most important thing is your downside risk. It's not to lose a dollar.
Our motto is buy without regrets, and so
if you can buy a property that will serve you for 10 years as opposed to 3 years, that will serve you well. It's something.
Buying a great property today, that's not just what it's about. It's also getting something that could be ripe for improvement when the time is right for that investor or for the next buyer.
You think about, right, lifestyle, what's important to you? How do you get to work? What do you need for your family? What amenities like parks and shops? Then you look at the budget.
Welcome to Street Secrets. I'm Chris Bates. I'm a mortgage broker since 2013. And in this podcast, we're going to be interviewing Australia's leading buyers agents, ones with decades of experience, have the local insider knowledge on the street, and can really help you with your buying process, no matter whether you're a first home buyer, upgrader, investor. In this podcast, you'll get access to Australia's leading buyers agents' minds every week on a Thursday. What's the word on the street? Welcome to Street Secrets. I'm Chris Bates in the studio today with Lachlan Delahunty. It's going to be an interesting episode. We're going to start talking about investing post-budget and, how you can approach it at a national level. Lachlan's got a lot of experience and I'm super glad he's on today. How you doing?
Good, Chris. Good to be back.
Lachlan, before we, some people might know you. You've got a very lot of success in recent time on social platforms. You've got a great business in terms of Follio, in terms of helping investors. But can you go back in time, sort of when you started to get involved with property, when you first became a BA, and how's it been going so far?
Yeah, it's been a journey. I was a property valuer for about 7 years, which is probably not the most glamorous industry, right? Doesn't get put up on any poster boards, but for me, fundamentals of property is so important. So I think anyone that's been through a valuation degree and qualification, and you sort of learn the basics and the importance of how to sort of understand property movements and those sorts of things. So it was a really good grounding. So that was now, 15, 20 years ago. And buyer's agency for me kicked off in about 2017 when the markets across Australia were pretty soft, right? So everyone thinks the last 5 years we've been blessed with such good market conditions, but it's important when I speak to clients, those that have seen multiple cycles, and as a valuer, I went through a couple of cycles, and now as a buyer's agent, I've been through a couple of cycles. So you can sort of see the patterns, see the mistakes that people make, and never get too ahead of yourself when the times are good.
Yeah, the valuation history is, or I guess the background to coming into a BA. I mean, where do you think obviously value a property and going through that process, but where do you think it really gives you just an extra edge than, say, someone who hasn't come from that sort of valuation background?
You see everyone's mistakes at mass scale, right? I did commercial and residential development vals as well. So you learn a lot about, what adds value, what doesn't add value. But you also see some valuers are doing 7, 8 valuations a day. And once you've done that for 5 to 6 years, you see patterns emerge, right? So I'm seeing a lot of evidence of when, this person's generated $200,000 or $300,000 of equity profit in a really flat or declining market. So there was people making money in a declining market, which I found really interesting. And then you're seeing at significant scale, people that had lost hundreds of thousands of dollars, and people don't realize the last 6, 7 years, the commentary around you can't lose money in property. I think people are starting to realize that now. But I was in a Western Australian market from 2014 to 2017 where some people had lost $400,000 or $500,000 on a, $900,000 asset. We're talking about 100% discount. So you start to see those trends at scale of what not to do and potentially what could work as a strategy when market's cool. Because it's all about protecting your downside, right?
Yeah, okay. So let's go down on the Perth market. I do think it gives you it's had a massive boom, which was probably pre-you, but you're probably living over there and you saw it. But, what did it sort of teach you, the Perth market? Because, it had such a tough time, for a good decade there. Is that the thing? The things that really held the values, the things that still sold well, the things that really struggled, the things with the biggest losses? Is it sort of by looking at where the pain was in the market, it sort of taught you and then I guess seeing the outcome post a boom, just seeing, I guess, the things that rose the most. Is that sort of how you put it together?
Definitely. I think you learn more in a downturn than you do in an upswing, right? I think when markets are rising, everyone's an expert. And we've seen that in the last 5 years through this wave of buyers agents, and a lot of investors have done well, but a fair bit of it's been just luck. When the tide rises, all ships rise. So the tough times for me was when I started as a real estate agent before Value in Melbourne, post-GFC. And that was really interesting. We're talking 2008, 9 and 10. And I was at university, so I was trying to learn, I was studying valuations and property, but I wanted to learn on the ground. I didn't necessarily want to be a real estate agent. But seeing the pain during that period of where people lost a lot of money was identical to the same thing that happened in Perth, 3 to 5 years later. So you can see the assets. And when I speak to clients now about investing, everyone wants to make money. If you're not, if you don't invest in property unless you've got capital growth focus. However, the most important thing is your downside risk. It's not to lose a dollar. And what's interesting in both that Melbourne market, post GFC, and then Perth from 2012 to 2016 in a really tough time, there were assets that held their value and in some instances actually continued to rise, albeit marginally, but we're talking maybe 5% growth over a 5-year period, which when the total market's fallen, in excess of 20 or 30%, similar to probably what's playing out in Sydney a little bit at the moment, it's quite interesting to see what assets do hold their value and what get crippled in a really tough time.
Yeah, I think that's absolutely, and people believing that, people never lose money on property. It's just so, rife in, people's beliefs that any property goes up, not all property rise at the same rate, and I think you're right. When people go through, and particularly when they've got exposure to, certain assets, they start to actually see, wow, God, I shouldn't have bought that off the plan apartment, or my friend had that, or my parents, or whatever it might be, or I shouldn't have bought on that main road. If you think about just the investment focus philosophy, pre-budget and post-budget, like how much of a flipper has it been for you? And, in terms of the clients that actually can work with you now versus pre, like, has it been a huge shift?
It hasn't. Look, the sophisticated investor that's, been through cycles, been through the journey with us, as bullish now than probably more bullish now post-budget than they were pre-budget, because everything's a cycle, right? And the tax policy that was brought out certainly wasn't favourable for investors, but you don't invest in real estate to save tax. You never have. It's a vehicle that enabled you to hold property potentially and cash flow different assets through negative gearing. And obviously the benefit at the end in terms of your capital gain was slightly different, but the fundamentals are still the same. And I think those that are more sophisticated, that have been through cycles, the conversations I was having in January and February with them is we're a little bit nervous, right? Markets everywhere were peaking. Unaffordability was at the highest level nationally. And that's the time when the sophisticated money sort of held back a little bit and said, look, the wave of investors, the wave of buyers agents, it's really bullish at the moment. Let's be a bit cautious. We're interested in those same buyers now post-budget are going, okay, let's do something, because the tune has changed and they're being a little bit more greedy when probably the mass marketing and the mass media have a really negative sentiment on where things are at.
Yeah. So when you say sophisticated investors, you're talking either with quite significant amount of equity and income, they've got some properties, they've got some protection, rather than the sort of the first one to sort of property investor. Is that sort of, they're often still pushing on because they've got the ability to offset positive cash flow, like they've got equity, they've got their home already, like they're seeing, and they've also got time and they know how markets work. But the first one to property investors a lot less likely to come to you.
Yep, that's so how we break it down. You've got a first-time investor where that market, that's more like a sheep mentality, right? Media says it's bad time, markets are going down, I'm going to sit back and do nothing until, they were the type of buyer that was buying in January and February, right? Probably at the top of the cycle. Then you got your mum and dad investor, which they might be an accidental investor where they've bought a property and then they've rented it out. They're sort of on the fence too. They're reading papers and they're a little bit nervous. That next echelon up, they might have 2 or 3 properties, lower debt on their primary place of residence, or they've just been proactive in investing and following markets for the last 3, 5, 10 years. So they've been educated enough to know that cycles will happen. There's always rises and falls. No market, Sydney's a great example. When we were there in October, the sheer confidence in that market that prices are never going to plateau, prices are never going to come off. It was almost like, Sydney's going to be the once in a generation market that never goes through a stagnation period. Now, those sophisticated investors have been through enough cycles or have educated themselves to understand that nothing's ever as good as what it appears. There's always a period of time where things will stagnate. Equally, things aren't as bad as what's typically portrayed in the media. So they're just seeing this as an opportunity in time where they can probably buy at a discount to what they would have had to pay earlier in the year, or potentially what they'll have to pay in 12 or 18 months' time.
You had I know where you used to work prior to starting your business, but, there's obviously this proliferation of investment buyers agents that sort of, launching businesses and starting, buyers agencies over the last 3-4 years. I mean, how did that sort of, as you're also launching in that with a new sort of investment focused BA business, how did that make you feel, I guess, in terms of how did you protect your clients with a much more professional sort of service rather than, a lot of what the marketing that was happening over that sort of 25 to 26 period?
Yeah, there is every, ex-agent, selling agent or barber, hairdresser, mechanic are all buyers agents now, right? So there's been a huge wave of that. And we've seen this before. And unfortunately, I've been around long enough now to see different periods of time. But the version of a buyer's agent today, back in sort of the late 2006-07 period when, I was getting into the game, it was more the house and land package spruiker. So they've redressed themselves up now as more of an established buyer's agent in that sort of 2003 to 2005 period. Because, back in the day, I'm sure you remember it, Chris, that you'd go to a seminar and you'd have a spokesperson at the front get your credit card in the air, put your credit card if you want to make, $1 million in the next 3 years, and then they'd go and buy you 3 house and land packages in Melton in Victoria or, far southeast Queensland in a suburb you've never heard of, out on the fridges where there's plenty of supply. So that format's changed from what was a pretty devastating period where a lot of people lost a lot of money to the more modern day buyer's agent where, they're a little bit more sophisticated, which I respect in terms they buy established property and they were doing that pre-budget. But again, they're very good at sales. They spend more time on sales than they do on actually the due diligence of what they're buying. So you'll see, the tide's changing with that now post-budget. Cash flows become more important. So I've noticed a big shift in the last probably 2 months where house and land package spruikers are back on. Get your credit cards out and let's go and buy something in the middle of nowhere. There's a big push to commercial, which we do commercial transactions for the right client, a sophisticated investor, typically entry price points $1.5 million. My concern in that commercial space, you're getting a lot of residential real estate buyers agents that know very little about commercial, but are pushing it from a cash flow point of view. So I think, and going out there and buying retail hairdressing tenants that have huge vacancy risks and don't really know what they're doing. So my biggest fears are in that space where people are now stepping outside their level of expertise to try to add to their service base to capture a market share.
Yeah, I think you're right. I mean, the commercial's going through the roof. You're right. I was a resi, now I'm a commercial. There was the house and land period, then there was the off the plan period and the mining town. Then there was the 100 properties in 1 year sort of mentality as well. I mean, were you a big fan of the sort of quantity versus a small number of property strategies? And, I guess, how do you sort of feel about that going forward and how are you sort of guiding your clients on what's the right property for them?
Yeah, see, it's definitely against my philosophy of investing. I've always been quality over quantity. And there's many reasons for that, and it goes back to my ethos of investing during, when good times, pretty much everything goes up in value, and we're seeing that with regional towns that have gone on a boom. You've seen mining towns go on a boom, and people remember that during that moment. But being through some serious downturns, things that get absolutely smashed are those exact markets where people have taken strong positions in the last few years. So those that have gone and bought 10 properties in Gladstone, well, people won't realise, but in the sort of mid-10s, 2010s, that market actually fell by 80% in about a 3-year period. Same in like Karratha in Western Australia, there's been huge movements. I had one of my clients many years ago actually sold a property to another investor, an East Coast investor in Karratha for $1.2 million. 12 months later, they had to sell that property for 312. That's how quickly these markets can fall. And I just don't think the modern day buyer's agent hasn't been around. It's not their fault. They're probably not old enough, right? They've just, left school and they're probably second year out there and beating the drum of a buyer's agent, but they haven't been around to see when things get tough, what properties get hurt. And having an abundance of properties, 5, 6, 7 in your portfolio in speculative areas is a dangerous strategy versus having 1 to 2 blue chip, very strong assets in key locations, capital cities, infill, where families want to live. So you're protected by school belt areas, you're protected by owner-occupiers wanting to trade in those markets in good times or bad. It's just a very different strategy. And make money fast, build a portfolio quickly is what people want to do, and that's what they want to hear. The reality is it might work for a very short period of time, but over the long term, it's a very challenging strategy to be successful over a 10, 20, 30-year period.
But you're obviously over in WA. I mean, the Perth market, is there parts of that where you think that a lot of, because it was extremely hot Perth, extremely hot Brisbane, extremely hot Adelaide, Melbourne, not so much, obviously Sydney, high price point, less investors, much more owner-occupier driven. So if you think about the Perth market, I mean, there's someone on the ground, lived and breathed it for 10, 20 years. Did you just see that parts of the market were exploding way beyond what locals could afford and are giving you a bit of a concern for the people that bought into those markets?
Definitely. So we've taken strong positions in Western Australia over different periods of time. We got in there early, and everything we do is based on data, right? And this is probably where my biggest concern on for the modern day buyer's agent, there's no substance behind the decision making. If it's not data backed, then don't do it, right? So, and albeit data can be different, you can read it, it can be manipulated for sure, but you need to have a baseline in terms of why you're investing. And in 2018-19, the data in Melbourne, the data in Perth was very strong. Vacancy rates fell from 7% down to 2%. Stock on market reduced from 16,000 down to 7,000. There was a lot of things supporting the market, probably not too dissimilar to what we're seeing in Melbourne at the moment. So we took strong positions in market, but a good example of what you're telling me is we took a position in the Rockingham Mandurah market, which is satellite city to Perth. It's about 45 minutes, so very commutable, which is important. When we talk about regionals, we don't buy in isolated regionals. We only buy in commutals, which is typically within an hour of a major city. So they're pretty much part of the larger metropolitan. And we'll buy in those assets for $350 to $450 in those areas. But again, with the focus of owner-occupiers, noting that if the investors aren't there, a local buyer who might work a fly-in, fly-out of the mines can live close to the beach, have a 4-bedroom, 2-bathroom house with a backyard. We started to sell them when the market and the data suggested the market was topping, late last year, early this year, and we were selling them back to buyers agents, East Coast buyers agents, for $850 on a 3.5% yield. And that was concerning. And we're not talking about one or two buyers agents. We're getting multiple offers, no on occupiers, 8 or 9 buyers agents trying to buy these for their investors. And that concerns me. When you're buying top of the cycle like that, we've already doubled our money. Yes, there may be still, slightly more uptick in that, but it gets really hard to foresee when the local market can only afford, on a baseline, probably 750 stretching out to an 800. So you've just start to rule out your ability to sell back to a local market. That's time for us as an advisor to say this is a good time to exit the market, because our fail-safe, if the market is to flatline, the local market can't afford it.
Yeah, it's interesting. So you've getting to the party early, but then you tried to get out as quick as you could at the top. I mean, yeah, is that sort of when you originally bought it though? You probably thought it was sort of like a long-term buy and hold, and then the strategy had to shift just because the market ran so hard. Is that sort of where the adjustment came?
Exactly. We buy properties to hold for the long term, and anyone that tries to take shortcuts on that typically fail. So there is always an exception to that when data allows. When a market does close to 100% growth in 4 years, and it's clearly, the fundamentals are suggesting that there may be a stagnation period and there's an opportunity cost to those dollars, well, then you have to consider it. But some of our clients will continue to hold that. Probably 20 to 30% of our clients have sold. The remainder will continue to hold that because they have low debt on it. They've got a really good rental return, and they can hold that through to the next cycle, no problem. And they've got serviceability that might allow them to buy into another market. So there's no opportunity cost that they're losing. It's more for those that have had a change in life circumstances. They might have upgraded the home. They don't want too much exposure to debt, or they can de-risk their exposure that way. And or they've don't have the serviceability to get into another market that may represent better value. So my big advice to investors and clients, you don't sell unless you have to, right? Because long-term compounding growth, property is a good long-term bet. But opportunity cost and life, can get stressful, and at times you do need to adjust. And that 30% of the clients that sold back to buyers agents were in that small portion that may need to do something else.
Yeah. So if there was a real benefit of selling, as in, paying off the home loan, could reborrow and enter a different market. You still got the servicing, you still got the job. Yeah, you're paying capital gains tax, but you could take that gamble because there's other wins on the other side. But for the investor where there was limited options of what they could do with the money, whether it's income or borrowing capacity, sit and hold it and don't pay your capital gains tax and if a bit of volatile in prices doesn't matter, you're still getting rent, you're still sort of on top of your mortgage, and then just got to hold it to the next sort of run. Is that sort of how you guided them?
Yeah, in the situation where they don't need to, and every client's different, right? And that's pretty cliche, and I hate to say it, but it really does depend on the goals, where they're at in their stage of life. Are they later in life? Are they early? Some of these clients have got them fully paid off, and they're getting $30,000-$40,000 of positive net income, and they're winding down work, so it's going to pay for some of their retirement fund. So every strategy is slightly different, but again, unless there's the opportunity cost has to be significant to want to sell, repurpose and buy. There's a lot of buyers agents there that have a minimum hold period of 3 years, go into a market, buy, hold it for no longer. So they've got a maximum hold period no longer than 3 years, and then try to flip that, get out and go to another market. Your entry costs, your extra costs, when you look at stamp duty on the entry, plus buyer's agent fee, plus selling agent fees on the X's, plus your holding costs, you need significant growth, minimum sort of 50-60%, which a lot of these markets on the macro high level do that, but not on the micro in terms of what they actually bought it and sold it for. And the moment something cools, like we're seeing at the moment, there's been a policy shift or interest rate rise, well, they're not getting those sales prices. A lot of people in Townsville or Gladstone aren't getting the valuation that they were quoted from the bank bill, which might have been 20% higher than what the actual current value is. So they're making decisions on misleading information in that regard, and then they've gone to go sell it for $750, but the highest offer's at $650. Well, their net gain out of that might be only sort of $50,000-$60,000, which isn't enough to warrant the risk they've taken on.
Yeah, okay. So you've I think you're right. I think the danger pre-budget, which was always a risk, no matter whether the budget came or not, was sort of trying to basically, make money on short time frames. And yeah, if the market's all going up, great. Yeah, potentially you make some money, but then you got to pay capital gains tax on that. But then you're right. If a market does shift, they basically get stuck holding poorer assets, right? And even post-budget, that's even way harder just because of the CGTs significantly higher, particularly if you're on a higher sort of tax bracket, right? Whatever you do make, and if it doesn't work well, you basically get stuck holding a property and you've wasted the opportunity. So you're sort of saying much longer time frames, much more sort of buy and hold. And, if the market does turn, you've still got much better protected assets. So where are you sort of looking now to sort of a national level, when you sort of got a client, say 30s, 40s, that do want to just, they've got on top of their home loan, they don't want to upgrade their house, they just want to get one investment property. Is it really, you're looking at certain cities much more than others, and, are you really trying to avoid others?
Yeah, so broadly speaking, Victoria represents good value, and that's no hidden secret, right? We talk about it a lot, specifically Melbourne, but there is pockets within pockets. Melbourne's a big city, and you can't just put a blanket rule on Melbourne and go and invest in Melbourne, you're going to make money, because there's markets there that are falling by, 1% a month, and there's markets that are increasing by 0.5% a month, right? So it is markets within markets. So where I see some opportunity for the right type of clients is post-budget, do now have to keep an eye on cash flow, right? Our old methodology of buying the worst house on the best street, land banking really good real estate, and knowing that we're going to get a negative gearing benefit, that strategy doesn't quite work unless there's development upside. So we look at opportunities now where we can add value, so be that through the form of development or renovation, where you can increase your cash flow, because your cash burn's now more significant than it was pre-budget. So looking at those assets where we can achieve higher yields, so you can cash flow it, but not deviating from what has worked for the last 100 years. And that's quality blue chip property with owner-occupier appeal. There's such a flood to these investment belt areas, house and land package areas, lower price points, going in there and buying things for, units, one betters in out on the burbs for sort of $300,000. It's a risky exercise because, again, you're trading investment properties to investors, and when the music stops, as we're seeing in some of the regionals around Australia, there is no buyer, and that's what people fail to. Some of those properties or areas we're talking about, mining towns, people don't realise it's not like you have to sell at a discount. There's properties in Australia now in regional areas where there is no buyers. You actually can't trade it, so the floor is so low that you actually can't sell it. Now, that's a stressful environment to be in. So that is an area to stay clear of. But where you'll always find a buyer is typically where areas that exceed 80-85% owner occupiers, right? Because of school catchment areas, because of proximity to train lines, transport, infrastructure, schools, supermarkets, shopping centres. Those fundamentals haven't changed, but it's trying to identify where those opportunities are. Becomes a bit of a science when you dive into the data, but that's our job, right? That's what we're here to do, and that's why we're a buyer's agent that relies on data. Because if you're out there with the masses, well, you're just going to be trading investment properties. It's going to be very difficult, because I think the next 5 years are going to be a lot harder than the 5 years we've had.
Yeah, I think you've, it's census day today, which this won't go live today, but it's that's one of the key stats that I think when you're looking at the owner-occupier rate within suburbs and, I guess the people that are moving to those suburbs as well, I think it's, very, very, it's always been a tried and tested approach. But when you said sort of a value-added opportunities, do you think that a lot of the future investor will move into sort of smaller scale developments and sort of duplexes and townhouses and, trying to then potentially, get the negative cash flow or increasing dwellings? Is that sort of, and you're still getting quality land, but now you've been able to get, high yield as well?
Yeah, I think people will try it. What they'll want to understand pretty quickly, like developments, just generally speaking, it's a risky game, right? Like there's a lot that can go wrong. There's planning risk, there's funding risk, there's construction risk. So if you haven't done it before, you just got to be really careful. And fortunately, in my personal and professional world, we've sort of been in that development space and haven't really promoted it for the last sort of decade. Because of that reason, it's not for the faint-hearted. You need to have patience. You need to be able to wear a few blows along the way, because not one development we've done has ever gone absolutely according to the book. That's just that is 101. So it needs to be for the right client, right level of sophistication, and I guess the right stomach for it. But yeah, pull that together with the right expertise. I think small scale development, duplex, triplex type sites is a really good way where you can still get quality land in owner-occupier dominated areas, get a really good cash flow because rents are surging in those areas because people can't invest in the established market, and you still get your negative gearing, your obviously capital gains benefit, as well as depreciation. So it's a form of that house and land, but you're just not buying out in the burbs where there's 10,000 lots that are about to be brought on in the next 2 years.
Yeah, you've seen a investor wave already to the house and land, and even the developers themselves are talking about, the inquiries going up dramatically since budget, and and then that's pushing up the sale price for the first home buyer who wants to buy the house and land package to live in, and and they're probably always going to build that anyway. So it hasn't really created more supply. Like it's just the same that was going to get built. It's going to get built anyway. It's just going for a high price, and the investor sells it. They're changing the rules, whether it's 1 or 2 years, how old you can hold it, but you can't hold it for that long until it's now established, and so future investors can't buy it. And so I think it's a real danger zone, and quite costly for the first home buyer who wants the house and land package, because now they're paying more and they've potentially got more supply coming on the market rather than people just living in the property for the next 10, 20 years. Do you think you're going to look at any new property? It might have been just a blanket no prior to the budget, but have you internally even considered that as something you might look at over the coming years, for very boutique, people who can't afford the negative cash flow that, do just want to get like a townhouse in an inner ring suburb, but,
Yeah, it's interesting. I'm pretty mindful never to say never, because, things change. The policy changes mean you have to shift. And albeit I've come from a traditional and probably a very conservative investment mindset, you need to be able to adapt. So are we looking at new built opportunities? Not unless we're developing it ourselves currently. Would I consider it? Absolutely, for the right asset in the right location where the fundamentals are strong and it's really good product, and you can transact that property to an owner-occupier very easily down the track, and we're buying probably at a discount. Yeah, I think there's a place for that. So I'm not absolutely against house and land, but very much in those outer burbs, outer fringes, you've just nailed it on the head. People don't realise it. There's a flood of investors, which goes against all the government intentions, that are going to soak up these properties. What we find happens then when there's 80% tenants in the area, they become ghettos. You go then try to sell the property to an owner-occupier. They're not existing because they want a price that's above what a local can pay. And do owner-occupiers really want to buy where 90% of the neighbours are investors? No. So you can't trade it to an investor because they get none of the gearing or capital gains benefits. So it's a slippery slope. But these people are very good at sales, Chris, as you know. They're fantastic at it, and they're very convincing. So my fear is that more people buy that type of stock. Where we will target, with the opposite end of the spectrum, higher value quality assets where we know that owner occupiers will pay a premium for those type of properties.
Yeah, I think I do think it's going to be one of the good things out of the budgeting time that we create this more infield sort of, duplex, and there'll be a better quality product that, the investor might be the first purchaser, but it'll sell to an owner-occupier 3-5 years down the line. And I wonder if there's going to be enough builders and enough, and then the investor basically overpays for that because there's just not enough good quality product. But I do think it's going to be good. We're going to potentially create some more infield where we haven't had that before. There's been a lot of buyers agents around the country, not so much more the established local specialists, but the borderless type, moving down towards sort of apartments and really high yield, sort of lower purchase price plays. How are you feeling about that? And when you're seeing that everywhere.
Yeah, higher density is dangerous. I put that in the same category as a house and land package out on the burbs. And the reason is it's because it lacks scarcity, right? When you're buying in a complex, really more than 20, you start to get into an area where it's not scarce because there's an abundance of that same product. And you can bring on that product very easily. And we've seen that. Brisbane's a great example. Apartments and units essentially didn't move in price for about, essentially a decade. They went backwards because there was an oversupply of apartments in Brisbane in sort of 2015 through to 2018. Then obviously there was a lack of supply and it's gone on a run, but I feel that market's probably going to enter into an oversupply in the next 5 years because they're building so much up there. But that's where investors need to look at scarcity. What is unique in the market? What will an owner-occupier pay a premium for? And it's probably not going to be a one-bedroom apartment when there's, in a complex of 60, 70, 80 others that are very, very similar. Yes, you'll get the initial sugar hit of a higher rental return because we've got a national shortage of property. But again, why are you investing in property? It's for long-term capital growth, and I just don't think that asset class achieves that.
There was a lot of buyers agents buying sight unseen, not having boots on the ground, buying anything, like you say, the buyer's agents buying the stuff off you in Rockingham sort of area. Like, how have you sort of positioned your business against, and I mean, it sounds like common sense, to be honest, but what are the things you do to make sure if you are going to buy in different states that you actually know what you're doing rather than just trying to apply, Perth fundamentals to the Melbourne market, let's call it?
Yeah, exactly. You need area experts, right? Like you need local experts. And same as in Perth, Perth's a big market, right? So when we took a position here, we had 10 buyers agents that specialised in 5 to 7 suburbs. So that's what you're paying for, that local expertise. Because as well as I do, Chris, in your street, in your suburb that you live, there's some streets that are better than others. There's some pockets of streets that you want to be. Some areas don't drain as well as others. Some get a bit of a look, some don't. So there's all these nuances that local buyers know that the rest of the state won't know, let alone people on the other side of the country. So our job is, we divide every market up into sections, and we have buyers agents on the ground, boots on the ground, that are specialised in that section of the market. So they know where the social housing is, even if it's hard to find on low. They know where the proposal for the new hospital is going to be built. They know what the local government's trying to do. Are they trying to bring on density? Are they trying to reduce it? That's really important. And I think anyone that's using a buyer's agent interstate must have boots on the ground. And that's not in the form of a property manager going through and taking an inspection video. And then you've got, I met with someone yesterday, they're in Perth and they're a buyer's agent in Melbourne for another firm. And I said, what do you mean? You're an investment advisor? You're doing the advice? No, I'm speaking with the agent. I'm the one that puts the deal together. In Ballarat and Bendigo. And I said, have you ever been to Ballarat? Like, I'm from Ballarat. And she goes, no, I've never been there. And yet she's bought 120 properties in the last 12 months in a market she's never been to. That scares me. That really does scare me, because I know even Ballarat's not a big town, but there's certain areas you definitely want to stay away from. So, and I'm not an expert in every market in Australia, don't pretend to be. And Melbourne, albeit spent, almost a decade there, I'm far from an expert in terms of that localised knowledge. So we need someone that ideally is being brought up in the area, that knows the streets far better than any agent or anyone else trying to do it themselves.
You've seen a few collapses in the sort of, or definitely, firms that have been struggling in this world. What are some of the learnings you've seen on the back of the sort of the last few months of, I guess some changes within this space? There's been some, obviously, some real volume that these guys have been purchasing. I mean, have you sort of seen some of the client stories out the other end where, you've got your clients coming to you and they're a bit concerned?
Yeah, definitely. I think there's lots of learning, right? And it's No, probably the biggest learning. It's like, don't get oversold, but understand your portfolio better than anyone else. No one cares more about your money than you, and just don't take advice for granted. Some of these clients that I've seen have got 4 or 5 properties which their serviceability shouldn't allow, but they've used bank valuations to continue to their spending. And now that's come out and they're in situations where they can't cash flow these assets. They're needing to sell, and then what they've been told or what their valuation they've been handed to, and some of these firms will go and get 3 valuations, and one's at 600, one's at 700, one's at 900. They'll give them the 900,000 and away they go. And the reality is that's fine. And a broker's job often is to get sometimes debt and be creative with that, but not at the, misinformation to the client, telling them the property's probably only worth 700, maybe 650. But we've got a great valuation result for you. As long as they're aware of that, because I've had clients saying, look, we can sell this one for 850. And in Gladstone, and I'll say, well, okay, I'll make some calls and speak to the local valuer and or some local agents. They said, oh, look, we've probably maybe be able to get you 620 for that. And I'm like, well, that's disappointing. So it's just knowing your numbers, being across, real life data, and that's hard to do because not everyone has access to the data that we have, but it's important. I think knowing your numbers is more important now than it's ever been.
Yeah, I mean, you've highlighted a really good one, actually. I think obviously quality of asset, but how did they actually build that? Buy that second or third one, it was, and I think the banks are also knowing that those valuation tactics, coming from a valuer background, you sort of understand the game, wasn't good enough, to be honest. And, it's put clients in a pretty awful position. I can think of some clients who have come to us, they've already engaged a buyer's agent, they've found us as a broker, and then we've helped them. We've sort of, they've gone ahead with their buyer's agency sort of purchase. We've warned that we might not be in agreement in terms of the philosophy. And then 6 months later, they said, oh, we're going to leave because we've got this crazy bank val and we've seen it. And so their internal sort of partnership broker. And and the issue is if you're leveraging up, in that situation past what's the value the property's worth, there's no headroom if things unwind, particularly if you've gone and invested that money in another property and you just compounded it. So I think you've hit a nail on the head. And I think that the problem with that speed of that transaction is that FOMO effect, is that, if you don't buy now, you're going to miss it and, the short-term growth. So it's going to be interesting to see how that plays out. Because I do feel like a lot of people are going to get burnt, unfortunately, because of that behavior. And unfortunately, some brokers have played in that space as well by, partnering with these organizations.
Yeah, definitely. And I think, albeit sometimes the intention comes from a really good place as a broker, right? Your job is there to help the client. And if they, desperately want to do something, if you always try and do the right thing. But if it's coming from a place, misinformation, and a lot of that's what it is. It's trying to be real. And if I've got a client with 5 portfolio and they think they've got $2 million of equity, and the reality is they've probably got 800 and they can't cash flow this, I look like the bad guy when I'm saying your portfolio is not worth what you think it is. And of course, everyone wants to be told, good news. So they'll go and speak to 3 other people and there'll be someone that tells them what they want to hear. And they're just deferring what is going to be catastrophic when, the shit hits the fan, so to speak. And they're going to have to force sell a lot of properties and undo what has probably been, a few years of really good work. They find themselves year 6, 7 or 8, at or below where they started.
Yeah, I think there's the short-term new client, and, not worry about what the clients I was advising 3, 4, 5 years ago and how they're doing. I think that's quite dangerous. As markets move, you need to have that sort of longer term sort of trusted advisor role, which sounds like you and the team do, which is, comforting in this sort of investment world. I think that the people that are, the clients have actually really thought through the long-term strategy and making sure they can ride waves in markets, not just sort of try to capture a short-term growth. So Lachlan, awesome chatting to you today. And I appreciate you coming on and explaining your philosophy.
Thanks, Chris. Good to chat.
Thanks so much for listening today. We hope you got lots of value out of it. If you'd like to speak to our guest today, there's links in the show notes on how you can get in contact. And if you're buying your first home, upgrading, renovating, or need any finance-related queries, obviously we'd love to help. There's links in the show notes to us as a mortgage broker, and we look forward to next week's episode.